Hello viewers, today we will see what DeFi stands for, why it is important in the crypto economy, and how it works. So, before starting this topic, I just want to tell you that, according to the Triennial Central Bank 2019 survey, the daily volume of the Forex market is more than $6.6 trillion, which means that the volume of the Forex market is more than 12 times the size of the crypto economy. Just imagine how many types of charges are involved in this scenario. So, the first purpose of decentralized finance, DeFi, is to eliminate all these charges while trading and make it available to the general public. For example, in the case of $1 trillion per day of exchange volume for Forex trading, we are charged millions per day, which is just 0.1% of the market value. Now the total number of charges in this scenario is for 365 days in a year, which is $36.5 billion per year, and for 5 years, which is $181.25 billion, which is quite a lot to distribute. Thus, the purpose of a decentralized financial system is to eliminate all these costs while doing business and make them available to anyone around the world. Blockchain technology makes it possible to create a decentralized financial system that allows anyone from any place in the world to connect and do business directly with each other. So, decentralized finance will surely reduce costs, eliminate the need for a middleman and make it easier to do business. A decentralized financial system has all the facilities of a centralized financial system and, in addition, has several benefits for both the users and the service providers.
So, now the question that will come to your mind is, what is centralized finance? According to the famous finance website, Investopedia, banks, corporations whose ultimate objective is to earn money, hold your money under centralized finance. Third parties that enable money flow between parties abound in the financial system, with each demanding a charge for their services.
Working mechanism of centralized finance. Suppose you use your credit card to buy a packet of milk. The charge is sent from the merchant to an acquiring bank, which then passes the card information to the credit card network. The network clears the charge and asks your bank for payment. Your bank accepts the charge and forwards it to the network, who then forwards it to the merchant through the acquiring bank. Because retailers must pay for your ability to use credit and debit cards, each entity in the chain gets paid for its service.
Now back to the topic of DeFi. According to the famous finance website, Investopedia, decentralized finance, DeFi, is an emerging financial technology based on secure distributed ledgers similar to those used by cryptocurrencies. The system removes the control banks and institutions have on money, financial products, and financial services.
Some of the key attractions of DeFi for many consumers are: it eliminates the fees that banks and other financial companies charge for using their services. You hold your money in a secure digital wallet instead of keeping it in a bank. Anyone with an internet connection can use it without needing approval. You can transfer funds in seconds or minutes.
How does DeFi work? Decentralized finance uses the same blockchain technology as cryptocurrencies. A blockchain is a distributed and secure ledger or database. DApps are applications that manage transactions and operate the blockchain. Transactions are recorded in blocks on the blockchain and subsequently validated by other users. If these verifiers agree on a transaction, the block is closed and encrypted, and a new block containing information about the previous block is generated. The blocks are chained together by the information in each subsequent block, thus the term blockchain. Because information in prior blocks cannot be modified without impacting subsequent blocks, there is no way to edit a blockchain. This approach, along with other security procedures, contributes to the blockchain's secure nature.
What type of currency is used in DeFi? DeFi is supposed to make transactions using cryptocurrency. Because technology is continuously evolving, it is impossible to predict how existing cryptocurrencies will be applied, if at all. Much of the idea relies on stablecoins, which are cryptocurrencies that are backed by an entity or are tied to fiat currency like the dollar.